Hello everyone, welcome back. It's been a long time, I realize that. I've been having a busy couple of months. I haven't actually done another video. I haven't done a video since I looked up on here July 5th, I think it was, and that was a very long time. I know I'm actually redoing the show now, going to be a little less frequent as opposed to every weekend, every couple of weeks or so. Going to start having some of my Leaders Investment Club friends on, the likes of, Austin Schwab, who does global macro over at Leaders, Julian Marchese, who was just on Fox Business running his, him and John Paul's fund, Remora Capital, which is a quantitative long-short fund, but he also used to do and still does global macro. Gonna have some options people on, gonna just get various different views on the market. My friend Nolan Parker most likely will be on, so it's gonna be a little less infrequent, a little longer, a little bit more, discussion as opposed to just running over trading data. I decided to redo this video style because I realize I'm not the fast focused trader that some people, think that I am, or that I sometimes act like on the videos. I do take into account all that quick data, but I feel like I'm better at discussing long-term objectives than, and broad themes than really going after, okay, this data point means this or that data point means that, like in the short run. I will still cover some day-to-days, some pretty frequent activities in some stocks. I'll also still cover my portfolio, some of the broader changes I have made throughout the months, and just kind of keep the format the same, except just keeping things more broad and longer term than very specific points on data. And with that, I'm just going to dive right into my overall thoughts on the markets. Got to chart the S&P 500 ETF on here with a couple moving monkeys, as Mr. Keith McCullough likes to keep it on. If you guys that have watched me before know it's the 5221, as you can see right here. I also, on my longer dated charts, I also use not only price, which are what the moving averages go and show you in terms of trends, also volume, and then volatility as well. I kind of like volatility just to go and see, historic. It's both historic and implied. Of course, with the Trade Monster platform, you can do all this stuff. Not that Trade Monster sponsors me or anything like that. I just like it. So since I left off about here, the market has gone up, definitely. Had October was really scary for a lot of people. We had a 10% decline intraday, I think, on that Wednesday, October 15th. Then we closed. Yeah, I believe that was Wednesday. And ever since then, it's been pretty much straight up, with some interesting effects like decrease in oil prices and a strong rally in the U.S. dollar, a ridiculously strong rally in the U.S. dollar. And on top of that, more easing in the ECB. ECB actually just announced on Friday that they will start doing quantitative easing using by buying asset-backed securities worth a total of $1 trillion. That's a fourth of the Fed's balance sheet. The Fed, now that I'm on that subject, has stopped QE, and it looks like they're going to do a rate hike somewhere in the second half of 2015. All of this was pretty much announced throughout the last couple of months. And I kind of like the picture that we have throughout the world, even though it seems like Europe's about to go into another recession. Some parts of Europe are in recession, like Italy. China just cut rates and starting to give their banks a little bit more liquidity, which is kind of like a worrying sign. But I like that the U.S. is still growing strong, and if you actually paid attention to the PPI and the consumer price indexes that we had this week, you actually saw inflation was actually, I wouldn't say better because, better in my case, it was actually more than what people were expecting inflation to be. And we had this really, really kind of big discussion going on across financial media of, are we now in deflation? Dollars rallied quite a bit. Oil prices, commodity prices have gone down dramatically. I will put up a chart of the GLD. You know what? I'll just compare the GLD. and just across the 1 year. As you can see here, once we got past that inflection point, they've just gone complete opposite directions. Down 4% versus the S&P up 14%, SPY up 14%. And I actually like that we saw inflation tick up a bit, just because that lets me know that we're not in the secular deflation, that, possibly we can still get the 2% inflation that the Fed wants us to get. It's just that US dollar has just seen a lot of pickup in demand versus, what others have thought. I like that picture. I actually want to see rates going up. I want to see bonds going up, because rates going down and dollar going up doesn't really do too well. Prices going up, prices going down, rates going down. It's not a good. It's just not good to go and see for the equity markets. I want to see, dollar going up, rates going up, not dollar going up and rates going down. So with that, I actually do like TLT. I want to see TLT on a pullback, and I would like to go and buy some. But TLT has actually been a massive performer along with the utilities here. I'll display that with the SPY, just so we can go and not GL, SPY, just so we can go and see what a big divergence that this has been. If you've been on the rates, call, if you've gone and been on rates, if you've been long rates, congrats. Here's that capitulation move that we saw in October when rates just went absolutely crazy. And as soon as I overlay this chart, you'll go and see what I mean. S&P went down, TLT spiked up. I think the 10-year went all the way down to 1.8 or so. But actually, it's pretty interesting when you look at it. Besides some of these big sharp moves, rates going down, stocks higher, they've pretty much kept track with each other all the way until some minor parts of deviation. But you look through June through August, same correlation. March through April, same correlation. Same uptrend, but not exactly on the same track right there. And then the big divergence once we got into pretty much late September, all the way up to basically now. Rates and the S&P have gone just complete opposite directions. They're actually about up the same, which is really interesting. Especially now that I'm starting to look at this chart. I've actually never laid the two on top of each other like this, but it actually looks fairly interesting. I also want to go and compare that to the XLU, which I've been a part of on that trade since June, but just want to show the XLU against TLT a little bit higher, up 18%, and I'll actually change this to the SPY just so we can go and see, because the utilities and healthcare have been the leading sectors throughout this year, up 18% versus up 14%. And once again, some parts of the same track right here, all the way through late June, early August, up until once again to that late September where they started to deviate a lot. And the market went down, utilities kind of stayed up, and that was kind of like your hedge. If you had utilities on this entire year, once again, congratulations. I have had utilities on for parts of the year. So that's going into my broader market macro side of where I see the markets at. I just want to check to see my time. Oh, I'm flying through this. Going to go now to parts of my portfolio. See how things have been doing. As you can see, this is how I have my layout, positions, account value, all that stuff, market view news. And then down here is a watch list of different ETFs like EEM, TLT. I had on EEM for a while, then October hit and I took that off. I wish, and I'm going to go through each one of these stocks to show you where I made trades. I wish I added to AIG. So with that, I'm going to go into the charts. I'm actually going to go and bust this chart out again. Sorry. Oh, take that one off. But going back to this for a second, going back to some of my positions. One that I love that's been absolutely killing is Blackstone, and I'll show you where I entered that. I entered that early October, then added again into that whole swoon of October. Disney has been a nice gainer, just under 4%. Hedge is obviously the bear market ETF that I keep on there to go and hedge out. Coors has been a lagger, and so is Qualcomm, but I feel like they're both kind of come back. And XLU I've had on since June, and that's been pretty nice. Alright, so going into my portfolio. And I'm gonna, can't do that on here, I apologize. So I'll just go on here. So going through my portfolio, I'm also going to show you Starbucks. I'm going to display my trades. I'm also going to display my open cost basis, because those of you who know me know that I am ridiculously transparent. I try to be as much as possible. I'm going to close all this out so you can go and focus a little bit more on the charts. Starbucks, I've been pretty much, I made one trade right here to add a bit more. It's pretty much gone nowhere except if it breaks above 80. It hasn't broken above 80 this entire year. I'm actually going to bump this up to a 2-year chart just so we can really see, and then you can see my real open cost basis. You can see this has not really broken above 80 in a while, and if we can go above 80, I think we can definitely see a move higher. This is Starbucks' like golden part of the year right now, is winter. Hopefully lower temperatures can go and help them out there, like they did last year, and hopefully some of their new holiday drinks will help as well. I'm going to start talking to my barista friends over at my local Starbucks, see who likes the new drinks, how much traffic they're getting, and stuff like that. Here's Under Armour for the past year. It's been a dominator. I entered some more of my position here. If I break this out into a 2-year chart, you can see where my other positions start. But here, Under Armour's been really, really nice. And I want to see it break above 70 so it can continue this little move higher ever since October. Why am I doing a 1-week chart? I don't want days. The move in October, it hit 60 right on the dollar and then bounced. And I was on here Wednesday because every Wednesday my school starts at 9:30, so I was there on Wednesday and I was going, okay, should I buy it at 60? Should I buy it at 60? I was really hoping, I was really ready to put some cash to work. I had 32% in cash, and I was like, okay, should I buy it? I'm not sure. Should I break 60? If it breaks 60, I'll do it, because my open cost basis is on, for the various different ones, it is either it's cost basis is, and I do this because I'm so transparent, cost basis is 60.37 and 52.21. So I was really hoping that I could get that down. I should have bought it. I'm kicking myself because I didn't buy it, because it's just gone straight up since then. Going to XLU, I've had this on since last May. As you can see here, bought a little here in May, bought some in June, and it's been doing fairly well. I get 3% off of it. I was thinking about hedging it up here. I probably should have, but I like this one a lot. It had its dip actually in August versus October, and this one's been doing fairly well. All my performances that you see on my portfolio are not adjusted for dividends, so I'm actually up 8% versus 3% because XLU pays out 3%. Still like this trade. It's my hedge against growth slowing. AIG, one of the ones that I've held onto for a while, and my cost basis is right at 50. I should have bought some when it reached lower. Really should have. I could have doubled down, because ever since then, and I can show you, it's been up close to about 9%. So that's really been a nice one. They pay out a nice dividend. Earnings are looking good. Really like that one. JP Morgan, despite all the litigations, my cost basis for this one is 36. So it'd have to break 50 in order for me to start buying it again. And that's actually my smallest position. I'll get to the allocation here pretty shortly. Here's hedge. I actually bought some right here. Wish I could have bought a bit more. Sold it up here. Gonna start buying some when it gets near 11. when it gets near 11. It's actually right where it was right when that October situation first started. I'm a big fan of buying protection lower. I'm going to start selling some off here on any type of pop. I'm going to start selling it, then hopefully buying some more down lower. Going into Michael Kors. Oh, God. Kors has just been killing me. I've been a holder of 20 shares through, well, not through there because I actually sold some off, but when my account switched over here, I bought some on this earnings miss. Should have sold some. So it doesn't miss on earnings, but people just don't like it. I think it's going to run up to 76, which is about where my cost basis is. If it does that, if it starts filling in this gap over here, I'll zoom in a bit. It starts filling in this gap, which it kind of has been. I think you can maybe see it higher, maybe towards 80. This is actually going to be one that I want to actually hold into earnings and possibly eliminate altogether if I can get a break even. That's nice. Right now, I took a loss on one half of the position where I actually shouldn't have, and I'm down just about 3%, but I think it can make that up. As you can see here, I pretty much sold some almost on the exact bottom, and I feel like an idiot for doing that, but it's just something I felt like I had to do. Going into Disney now. Oh man, Disney. This has just been a great stock. I think this stock has a great future. I bought this ahead of earnings and pretty much riding it through. And then when the massive capitulation for Disney hit, they actually had a, if you follow at Nanix on Twitter, he actually showed a high frequency trading. It actually flash crashed all the way down here to 77, and it was within minutes too. I was watching this and I was tweeting out on that day. I was like, this is insane. This is crazy. This has to be bought here. You can't just have Disney at 77 and not touch it. So I went in and I bought some on that Tuesday. I bought some at 82. I should have bought it lower. I was a little scared to pull the trigger because I wasn't sure if it was going to go back down again or what have you. But either way, it proved to be really nice because it just started coming off of 90 ever since that earnings, but I think you'll continue to rise back up as we see holiday sales coming in. And so far with the position in Disney, I'm up just about 5%, and I'm actually loving it because this stock is just going to keep going on and on. Star Wars is starting to come out in 2015, as well as a number of other different films. Their new animated film, My Superhero or something other like that, I'm sorry, I'm forgetting the name, actually did really, really well, and I think Disney their future is just really good, and I think this is a stock that you almost have to own at almost any price. Qualcomm's been a little tearjerker of mine. Bought this in the summer after it had that tremendous down day. Bought a little bit more. Kept going, yields pretty well, had this nice run up into October. Then, of course, he just got absolutely torched the other week on its earnings because it missed based on some of the litigation fears over in China, which I actually like the litigation, believe it or not. Why? Because they're basically being investigated by the Chinese government because they have a monopoly. Any business that has a monopoly, I like. I mean, people always talk about FedEx and UPS and the airlines having an oligopoly and that being great for the stock, so why can't Qualcomm do really well because it has an oligopoly too? And what did I do? Of course, I bought this dip. I bought right at 69.97. This is my single largest position, and it is in the red, as you can see here. But I think it's going to go higher. I think it's actually starting to. We saw a nice day when it hit above 72. If it can break up 72 and it can start filling this gap, which I think it can. I think I actually talked to a data center expert. Who was that? That is my dad. My dad is an Emerson employee. He runs their data center solutions team. Full disclosure there, I do not trade any Emerson stock whatsoever. And this is what he actually had to say about this. It's they've kind of been referring to their servers. They've kind of been in their with some of their previous devices, but never formally. It's a brutal low margin business, and it might be a sign that they're struggling for growth areas. In theory, and I come back and said it makes sense though because of their chips and phones pairing with the services. In theory, yes, but only if they have a proprietary link, which is hard. They're probably worried about Hawaii, and I now know what you're talking about. AMR chips for servers. This is a result of acquisition they did last year. They use our server processor codes for their boards. Biggest question is whether Cloud Guys, which is their main target, will switch from Intel to ARM. But we haven't seen very much movement yet. But that could change as IoT eventually becomes real. But that could change as and what he says is it's basically going to take server guys a while, especially Cloud Guys, to go and adapt from Intel into Qualcomm. Qualcomm's really banking on a lot of these cloud providers to go and use their servers. If it can work, it will be killer. You'll start seeing these in Google, Amazon, Facebook, all the huge mobile cloud users, all on their servers using Intel chips because they're already in smartphones. I see this really working out well with Apple, actually, which is a stock that I actually really, really like. It's got tremendous momentum, but I also have discrepancies against Apple. So there's your little Qualcomm tip about from a data center expert. When they came out with that, I immediately texted my dad and asked him what he thought about that. Why? Because he knows this stuff like the back of his hand. He does this for a living. But yes, once again, full disclosure, I do not buy, sell any Emerson stock whatsoever. Blackstone. Why do I like Blackstone? Well, it yields 5%, and they're private equity, so I get a mixture of volatility from their hedge funds that they go and do, or beta from their hedge funds, and then I also get their real estate assets, which actually have been absolutely killing it. So I bought this in October as it started going down around $30, and I really liked it because it was cheap stock and I could buy a lot. Once October hit, I got some at $27.81, and now my open cost basis is, sorry, I have to go look at this. Cost basis is $29.52, and this has been just a killer trade. I've made 12% since then. You add in the 5% dividend, I've made 17%. Absolutely killer, just absolutely killer. Their earnings actually weren't that bad. They're selling off a lot of real estate. They're taking a lot of money off the table in the real estate market, which I actually like because I feel like that's going to, all that cash is either going to go into other projects that they have, help out their balance sheet a little bit. I'm actually targeting 34. If we can break above there, we start testing the 52-week high, which is 36. But we break above 34, we could test 36 for a 52-week high. I also think with all the cash that they have, they could possibly do a special dividend or increase the dividend this next quarter because they have a lot of cash from real estate assets that they have been selling off. Okay, so that's my portfolio. Some of the stocks I like coming into the year end are stuff like Apple. I actually really, really like Apple. I know it sounds stupid because I'm normally an Apple hater, but this was easy money from anywhere from $100 all the way up to $120. It's on the slow grind now. Me and my friend Max were actually talking on Twitter the other day about starting positions in Apple, but unfortunately it's on that slow grind where nothing's really kind of hit it. You need to see a pretty large move for it to go and, for me to want to go and buy it. Once again, portfolio allocation standpoint, we're looking up here, Qualcomm being the biggest, XLU 4%, Under Armour 12, Starbucks at 7, Hedge at 13, Blackstone at 15, Disney at 12, Coors at 6, AIG at 5, and JP Morgan at 3. I like my portfolio that way. I like Qualcomm a lot. I bought a lot of stock, so it obviously means I believe in it. Going forward, I really want to see just really strong economic growth because I think the stock market still is a good deal to run. I don't think valuations are that stretched. I think earnings, supports that valuation to an extent. But overall, I see the market going higher from here. I see it doing fairly well into the winter season. I'm going to be curious to see GDP actually. Another prediction of GDP comes out this week, which is also Thanksgiving, so we have a very short trading week. But I want to see how that does. That'll start, getting my ideas flowing a little bit on just how well we think we're going to be doing. I'm going to be paying attention to earnings in individual stocks, and I think that's what definitely, if you're equities, that's what you should be paying attention to, because out there are people that say, oh, why do you buy stocks at 52-week highs? If you buy the market at all-time highs like the SPY, I think you're a little nuts. But if you buy stocks that if you buy individual stocks like, Apple's actually getting in close to all-time. Apple is at all-time highs. If you buy, stuff like Morgan Stanley, which I actually really, really like. You buy stuff like Morgan Stanley on pullbacks or Qualcomm on nice pullbacks that aren't at their 52-week highs. They still have a lot of room to run. Blackstone is really, really jumping in there. I think that individual stocks are going to be where you want to be. I know some people have been, hearing this the entire time, individual stocks, but I really think that's where you can see a lot of great opportunities besides the overall market. I think the overall market is going to start doing low volatility, thanks to all the other liquidity from the various other central banks. I think we're going to see a slow grind like we saw in the summer, and if you're an individual stock picker, that's where it really pays off for you. And not these huge volatility moves. If you're a trader, huge volatility helps, but if you're like me, you want low volatility, slow grinds, because that's when your individual stocks start to shine. Thanks, guys, for tuning in. I know this was a little bit long, going almost on 30 minutes here, but I really want to thank you. Hopefully I can get a lot of support for this new format that I'm doing, get some guests going, and I'll announce those as they start coming in. I'm just starting up again because I had a whole bunch of different issues with college applications, theater, all this stuff. So I really, really appreciate some of you guys that have been emailing me, asking, when am I going to do my videos again? What do you think of this? What do you think of that? It seems to have switched from when I wasn't doing videos, a lot more emails. So hopefully, you guys like this setup a little bit. They're not going to happen as frequently, but, once again, thanks for your support on StockTwits on Twitter. Please make sure to follow me on StockTwits on Twitter. Email me any questions. I always have my email up there. Don't be afraid to tweet me questions. I love getting questions. Please go out there and follow all my Leaders Investment Club members. All those guys out there do a great job of providing content and have a lot of great ideas. Some of them have been completely on the money, like John Dukas calling for a short in stocks near September. That was great. Go out there, follow those guys. There are a lot of great guys out there, a lot of new guys out there that put out some great ideas. Thanks, and I'll see you guys next time. And I will also make sure to announce when next time is. All right, thanks, guys.